Contracts are at the heart of real estate transactions. At every step of the process, from listing agreements to sales contracts, to promissory notes to mortgage documents, contracts play a vital role in real estate. So, what is a contract? Simply put, a contract is a legally enforceable promise. We make promises in our lives every day. You might promise a friend to drive her to the airport. Or you might promise to lend your car to a friend so she can drive herself to the airport. These kinds of promises are not legally enforceable. Your friend can't go to court and ask the court to make you give her that ride. It's only an empty, unenforceable promise. A contract's useful that way. You can ask a court to enforce a contract, and the court will either make the other party perform their obligations under the contract or make them pay you money damages if they don't. So, what turns a promise into a legally enforceable contract? We'll talk about the essential elements of a contract later in this chapter. For now, it's enough to know that two people create a contract when they agree to perform actions for one another and intend to make their agreement legally enforceable. Let's take a tour of the types of contracts you're likely to deal with as a real estate agent. As you'll see, most real estate contracts involve one person giving money to another in exchange for the transfer of some interest in real property, ranging from a simple option to a full purchase. Sales contracts. The first stop on our tour is a sales contract. A sales contract is an agreement in which one person agrees to sell real property to another person, who, in turn, agrees to buy the property at a specified price before a specified date. Sales contracts may include other terms, and they can be complex, but every sales contract will specify a legal description of the property for sale, the exact price the buyer will pay for it, and the date by which the sale must close. A legal description is different from a property's mailing address. The legal description must identify the exact parcel for sale. The legal description may be a survey map, a meets and bounds description of the property's boundaries, or a parcel number from the local land records. Local law determines exactly what is required, but every sales contract will provide a legal description of the property for sale. In addition to property, price, and closing date, sales contracts often include other provisions that protect the interests of the buyer or seller. Many such provisions give buyers a way to leave the deal. For example, a sales contract may allow a buyer to withdraw from the sale if a home inspection reveals defects in the property, like a bad foundation or failed water test on a well. Leases. Our next stop is a lease. A lease is a contract that allows someone to possess and use real property for a specified time. Although we may be most familiar with apartment leases, a lease agreement can apply to any property, a house, a condominium, even empty land. Like a sales agreement, a lease needs to identify the leased property. However, because a lease is only a temporary transfer of possession, the property description is often less formal. A mailing address might be enough for a lease, but not be sufficient for a sales contract. The lease must also specify the person who will take possession of the property, known as the lessee, how long they will possess and use the property, and how much rent they will pay in exchange. When the lease ends, possession and use of the property returns to the original owner, known as the lessor. A lease agreement may include additional clauses, spelling out other obligations for each party. For example, the lease may specify who is responsible for repairs if a pipe bursts, or spell out when and how the lessor can enter the leased property during the lease. Options contracts. The next stop on our tour is an options contract. An options contract gives a party a right, but not an obligation, to purchase a property at a specified price during a specified time. During the option period, the seller cannot sell the property to anyone else. At the end of the options period, if the option holder has not exercised his option, then the seller is free to sell the property to someone else. Similar to an options contract is a right of first refusal, which gives a person the chance to buy a property before anyone else. For example, if a third party offers to buy the seller's property, a right of first refusal might require the seller to first offer the property to the rights holder under the same terms. The seller would only be able to sell to the third party if the person holding the rights of first refusal refuses the offer. Listing agreements. Our next stop is listing agreements, which are a real estate agent's bread and butter, literally. A listing agreement creates an agency relationship between an agent and a seller and authorizes an agent to sell a property on the seller's behalf. The listing agreement determines how and whether a real estate agent is paid. There are 4 major types of listing agreements. An exclusive right to sell listing, as its name implies, gives an agent the exclusive right to sell a property on behalf of the seller. The seller is free to sell the property on her own, but the seller can't ask another agent to sell the property while the exclusive right to sell agreement is in effect. Moreover, even if the seller sells the property herself, she will still be obliged to pay the agent the agreed fee. With an exclusive listing agreement, if a sale occurs, the agent receives a fee. An exclusive agency listing gives an agent the exclusive right to sell a property on behalf of the seller. But if the seller sells the property on his or her own, without help from the agent, then the agent is not entitled to a fee. Under an exclusive agency listing, the agent only receives a fee if the agent produces the sale. An open listing allows the seller to make listing agreements with as many agents as he wishes, and no agent has an exclusive right to sell the property on the seller's behalf. If the seller sells the property without an agent's help, then no agent receives a fee. With an open listing, an agent only receives a fee if she is the first agent to produce a sale. The last type of listing agreement is a net listing agreement. A net listing is notable because it is illegal in many states. In a net listing agreement, the seller specifies how much she wants to receive from the property, and the agent can keep any extra amounts earned from the sale. Many states disfavor net listings because they tend to create a conflict of interest between the seller and the agent. The seller may unknowingly underestimate the value of the property, resulting in an unfair windfall for the agent. Independent contractor agreements. The last stop on our tour of real estate contracts is an independent contractor agreement. Labor laws and tax codes treat people differently, depending on whether they are employees or independent contractors. State and federal laws require employers to withhold payroll taxes from an employee's compensation. However, a person may be considered an independent contractor if the person controls the manner, place, and time in which they perform their services. Companies are not required to withhold payroll taxes from independent contractor payments, and independent contractors are responsible for managing their tax responsibilities themselves. Traditionally, independent contractors show themselves to be independent by demonstrating that they control the time, manner, and place under which they work. Although a company may hire them to perform a particular task, the company generally does not tell them how, when, or where they should do the task. The independent contractor is responsible for getting the job done. How they go about doing that is their business. Real estate agents may work as employees or as independent contractors, and a brokerage firm and agent usually decide which approach they'll take when they begin working together. Often, real estate agents only earn a commission or fee if they make a sale, and they receive no other salary. This arrangement looks a lot like an independent contractor arrangement. However, state law usually requires brokerage firms to supervise their agents, and the more a firm supervises its agents, the less the agents look like independent contractors. This legal requirement can make it difficult for real estate agents to pass the traditional test for independent contractor status. Recognizing this difficulty, state and federal laws carved out special independent contractor rules for real estate agents. For example, the IRS considers a real estate agent to be a statutory non-employee if 1. The agent is licensed. 2. The agent's fees are based on sales rather than hours worked. And 3. The agent works under a written agreement that says the agent will not be treated as an employee for federal tax purposes. State law may provide additional requirements, but an independent contractor agreement makes it clear to everyone, the agent, the brokerage firm, and the state and federal tax departments, how the agent's taxes and payments should be handled. These are not the only contracts you may come across as a real estate agent, but these are some of the most common. Express contracts. Now, let's talk about the differences between express and implied contracts. An express contract is a contract where the parties clearly state all the terms of the agreement, and each party knows what they must do to complete the contract. An express contract may be oral or written and still be enforceable. A contract is an express contract if the parties have expressed all the terms clearly. Express contracts are common in real estate because a legal requirement known as the statute of frauds requires most real estate contracts to be in writing. In 1677, the English Parliament passed an act stating that if parties wanted a court to enforce certain kinds of contracts, those contracts would have to be written and would have to be signed by the persons bound by them. This idea has come down to the present day. Every state has a statute of frauds, and all of them require contracts regarding transfers of interests in real property to be committed to writing. There is one important exception to this rule. An oral lease for less than a year is enforceable and does not need to be in writing. Implied contracts. A contract may also be an implied contract. An implied contract may exist if the circumstances indicate the parties intended to create a contract. Implied contracts may be implied in fact or implied in law. For example, suppose Bob has plowed Sally's drive after snowfall for many years, and each time Sally has paid Bob a certain amount, even though Bob never sent her a bill. If a snowstorm struck again, and Bob plowed Sally's drive, but she refused to pay, a court might find an implied in fact contract based on Bob and Sally's long-standing behavior. If so, the court would require Sally to pay Bob for plowing. An implied-in-law contract exists when failing to find a contract would be contrary to law. Imagine Sally gave Bob a diamond ring and asked him to keep it and give it to her children when she died. Without agreeing to Sally's request, Bob takes the ring from Sally, sells it, and uses the money for himself. If Sally died and her children asked Bob to return the ring, a court might find a contract implied in law because not finding a contract would unjustly enrich Bob at the expense of Sally's children. You may have guessed it isn't easy to convince a court to enforce an implied contract, and you'd be right. Implied contracts usually only arise when essential elements of an express contract are missing. Terms haven't been clearly expressed, or no written agreement exists, or the parties disagree about what was said. Under these circumstances, courts are generally reluctant to find that a contract exists. As a result, it's generally unwise to rely on implied contracts. Express contracts, in writing, are usually the wisest course. Because implied contracts usually are only an issue when there is no written contract, they are rare in real estate because the statute of frauds requires almost all real estate contracts to be in writing. Bilateral contracts. Let's finish this lesson by talking about the differences between bilateral and unilateral contracts. A bilateral contract exists when a contract places obligations on both parties. When we think of a contract, we're usually thinking of a bilateral contract. Imagine that Bob agrees to sell Sally his watch in exchange for $100, and she agrees to buy it. Both Bob and Sally have obligations under the contract. Bob must give Sally his watch, and, in exchange, she must give him $100. If either party refuses to perform his or her obligation under the contract, the other party could sue to enforce the contract. Bilateral contracts are common in real estate. For example, sales contracts are bilateral agreements. The seller promises to provide clear and marketable title of the property to the buyer by a certain date, and the buyer agrees to provide a specified sum. The contract requires both parties to perform. A lease agreement is also a bilateral contract. The lessor agrees to surrender possession and use of property for a specified period, and the lessee agrees to pay a specified rent for using and possessing the land during the lease period. The contract obliges both parties to perform. Most listing agreements are also bilateral. The seller gives the agent the right to sell a property on the seller's behalf and agrees to pay the agent a fee if the agent produces a sale. In exchange, the agent agrees to use her knowledge and expertise to sell the property for the seller. Even an independent contractor agreement is a bilateral agreement between the agent and the brokerage firm. The agent acknowledges he is an independent contractor and agrees to maintain his license, follow the state laws and rules for real estate agents, and try to sell properties. For its part, the brokerage agrees to pay the agent commissions and fees on the agent's sales and to not treat the agent as an employee for federal tax purposes. Both parties have obligations under the contract. Unilateral contracts. A contract does not have to be bilateral to be enforceable. Some unilateral contracts are enforceable as well. A unilateral contract is a contract where only one party is bound to perform. Suppose, for example, that Bob loses his cat and posts flyers around the neighborhood that read, "If you find my lost cat, I will pay you a $50 reward." Many people walk past the flyer, Some even stop and read it, but none of them makes an effort to find the cat. Sally, however, stops to read the sign and realizes she has seen Bob's cat near her house. She rushes home, recovers the cat, and takes it to Bob. Does Bob have to pay her the $50 reward? Bob's flyer is a unilateral contract, a one-sided contract, because only Bob is required to perform under the contract. The people who stopped to read the flyer were not obliged to do anything. Sally was not obliged to return the cat, even though she knew where it was. Whether Sally chose to participate was entirely up to her. However, Bob is obliged to pay the $50 reward to anyone who shows up on his doorstep with his cat. Once a party stepped forward with his cat, Bob's unilateral contract obliged him to pay the reward. Unilateral contracts occur in real estate most often as open listings. Remember, an open listing is a listing agreement in which the seller agrees to pay a commission or fee to any agent who sells the seller's property. No agent is obliged to try to sell the property, but if they do sell it, then the seller is obliged to pay the stated fee. Open listings are unilateral contracts that create an obligation solely for the seller and create no obligation on the part of an agent. In the next lesson, we'll talk about the legal effects of contracts.